Is Enbridge Stock the missing piece in your portfolio? In this video, we're going to be covering the positives and negatives about Enbridge Stock, cover expert analysis of the stock and industry, and give my opinions on if this stock is a buy or a sell and for what kind of investor. Welcome to the Canadian Financial Channel, where me, a regular Canadian, talks about investing in the economy. Let's dive deep into the story of Enbridge. On the screen right here, we're going to have Enbridge's portfolio directly from their own investor relations page. It's how they describe exactly it is they do and what exactly they own. They break it down into four key categories. First, we have liquids pipelines. They have the largest system in North America and claim to transport something about 30% of the crude oil produced in North America. These pipelines have an export terminal capacity of 1.6 million barrels per day. Second, we have their natural gas transmission. They cover 30 US states, 5 Canadian provinces, transport about 21 billion cubic feet per day, over 75,700 miles of pipelines. They also have 440 billion cubic feet of natural gas storage capacity across North America. Third is their gas utility business, which serves 15 million customers across the Canadian provinces of Ontario and Quebec. This puts them at third place in North America by customer count and largest by volume, distributing a massive 4.9 billion cubic feet of natural gas every day. Fourth, and finally, we have renewable energy. Here, Enbridge brags about their 8 billion Canadian dollars in capital allocation into 5.3 gigawatts of gross capacity. This includes 2,172 megawatts of their own generation, which they claim delivers clean energy to 5.7 million people, including about 960,000 homes. So that's exactly what Enbridge owns. Now we should talk about how much money they make from what they own. So we're going to jump over to their most recent earnings report for this company. In the 3 months that ended June 30th of the second quarter of the year, they made a total operating revenue of 11.336 billion Canadian dollars. We break this down into sectors. They made about 8.1 billion from their liquids pipelines. This constitutes about 72% of their overall revenue. This is followed by gas transmission in second place, just shy of 1.5 billion, gas distribution and storage at 1.4 billion, renewables at 106 million, and eliminations at 196 million. So the lion's share here is coming from that liquids pipelines. And I think it's at least interesting to note how much importance was placed on their renewable business, considering how much it's actually bringing in the door. They were very quick to brag about having spent $8 billion, but their actual revenues from this category are not impressive. So now that we've covered what exactly they own, what revenues they make, I wanted to dig into what some analysts say about this stock. Personally, I had a few pieces that I was interested in. So first, I want to know how Enbridge compares to their peers, and maybe if any of those peers present a solid investment opportunity. Second, I want to know how Enbridge will deal with the near-term challenges, specifically the Trans Mountain Pipeline, but just generally other energy infrastructure investments made by other firms that might impact their dominance and pricing power. Third, I want to know how reliable this analyst thinks Enbridge's business will be in the medium to long term. If this analyst thinks the company will be around for the long run, do they also think this dividend will be safe for that time? So, on the screen in front of you, we have Morningstar's analysis of this stock. Their analyst, Stephen Ellis, covers a great deal about this company, including his projections of this company for the future. I wanted to share some of his findings and opinions about this company to answer my questions from earlier. Some key elements I read here. First off, Stephen rates Enbridge as of August 26 at 3 out of 5 stars. So good, not great. This comes with an estimated fair value at about $41, which is just a buck above where we're sitting today at 40. Gives this company an economic mode of narrow, uncertainty score of medium, and an ESG rating of 4 stars. So not amazing. He's not saying that this is the best company that he has ever rated, but he is definitely saying it's above average. He argues in this document that demand remains secure in the near to medium term, despite the increase in US domestic production, which might reduce the reliance on more expensive Canadian crude. He also points out that the mainline settlement over contracts that Enbridge have terms that extend to the end of 2028, and producers are now committed to Enbridge at a time when Trans Mountain might have been another option for them. So it looks like Stephen has answered my second question over the near to medium term. For at least the next 4 years, Enbridge will be in a position with pipelines at about maximum capacity. He argues that Enbridge's natural gas, utility, and renewables business will be the drivers for the consistent 8% EBITDA growth. He also gives Enbridge credit for their investments into renewables, despite how little those investments are currently paying off. He then gives some bull and bear cases for the stock, which I wanted to share here. He argues that the earnings profile is like that of a utility, which basically means safe and reliable cash flow, and therefore safe and reliable dividend income. He argues that the dividend is safe for the foreseeable future and that cancellation of Keystone XL puts Enbridge in a leading position to capture any new pipeline expansion demand. The bear case, he points out, the dangers of ESG-related challenges, that the Canadian oil sands are not a very environmentally friendly method of production, and that the renewables that Enbridge has invested in do not currently have a strong economic moat, and those investments would not stand on their own if not supported by the overall company. Putting all of that together essentially answers my third question. He argues that the dividend can grow at just above inflation for the foreseeable future, and that essentially this company's main risks are that it is an oil and gas company in Canada, and thus might run into environmental challenges. Finally, for this report, we have our competitors. Stephen argues here that of the near peers, the one company that we might find better value today is TC Energy. He points out the capital allocation of enterprise product partners is the best of the group, and they have the widest economic moat. Enbridge stands at the highest PE of the group, but sits slightly below TC and Enterprise in price to book, lining up with the fact they're also the largest market cap of this group. No one company on the list looks like they are lining up to take Enbridge's lunch, but they might be worthwhile to consider investing in, particularly since all four companies pay a dividend over 5%, both Enbridge and Enterprise pay almost 7%. So, last but not least, we're going to get to my opinion. Should you buy this stock? Well, I think, like most things, it depends on who you are and what your investment goals are. I think the ideal Enbridge investor is a Canadian investor with about 5 to 15 year time horizon, who's looking for a solid dividend and a stake in the Canadian oil sands. Now, I understand that might not be you, and it's not necessarily me, but just because we don't fit that profile exactly doesn't mean the stock doesn't have a place in our portfolio. There are plenty of reasons why you might want to own Enbridge. Canada has the world's third largest reserve of oil and has been rapidly growing out production and export of natural gas at a time when both these resources are at higher and higher demand with geopolitical strife. Wanting to own a piece of the pie without having to pick which company is extracting the oil is a strong way to make sure you get returns from this industry. The real selling point of this company is the very strong dividend this company pays. Depending when you are watching this video, it might be higher, but the dividend today sits at 6.63%. Enbridge themselves are very proud of their dividend growth, showing potential investors that they have grown their dividend at a compound annual growth rate, or CAGR, of 10% over the last 29 years, which is very impressive for such a high-yielding company. The final thing that might impact your interest in holding Enbridge is tax implications, which might not be your first thought when looking at possible investments. If you're a Canadian holding Enbridge, congratulations, this is a qualified dividend and is likely tax-free in a TFSA. If you're not, you're going to be paying a 25% withholding tax, which is higher than the regular American 15%. I read on Enbridge's page that American holders pay just 15% as well, but I cannot confirm this. I am not an American. So if you know and you can direct me to where I can find that information, please leave that in the comments below this video. I'm personally going to say that for me, Enbridge is a buy. Not about to bet my entire portfolio on this one stock, but I am going to be building a position inside my TFSA in order to capitalize on that dividend growth over the longer term. Now, I might be biased, but I believe that while renewable energy should be taking precedence over fossil fuels in lots of cases, that Canadian domestic production might become more and more important as time goes on, and will at least remain a part of our energy landscape over the medium to long term. If you are also building an Enbridge position or you've already built one, let me know your thoughts on this stock. Well, that's it for today, everyone. Hope you enjoyed this video. If you did, please leave a like and subscribe. I would really appreciate it. Talk investing and economy every week on this channel. If you have any topics you think we should cover, please leave that in the comments, and I'll see you in the next one.